when I was younger, I had one of my friends who wanted to buy a home when she was very young, but I don't think she really understood what being a homeowner meant, in the sense that once you buy a home, you can't really call your landlord anymore and say, hey, will you come fix my toilet, or will you come and, fix my whatever is broken. Once you are a homeowner, all of that responsibility is yours. And so it's a very big commitment that is a very good commitment, obviously, but you just got to be mentally prepared for that and ask yourself, am I really ready to buy a home? Okay. There's a big difference, like I said, when you're renting a home versus you're buying a home. Like I said, renting, you have no landlord. When you're a homeowner, you have to take care of the entire home. There are other bills that you have to pay. For example, you have to pay for water. You have to pay for waste management, trash, and things like that. Some of us have to pay for, well, depending on what your rental situation is, like gas and stuff like that. You have to pay for your county taxes of your property, which is included in the payment of the home. But there are a couple of other things that, as renters, we are not accustomed to paying right off the bat. Okay. Obviously, when you buy a house, you have to evaluate, are you financially ready to be able to pay a mortgage to buy a house? There are a lot of points with this. Obviously, the first one being, do you have a stable job, stable income? All lenders in the country will require you to have at least 2-year employment history to be able to qualify you for a home. Okay. If some of us are students, and once we graduate, if we are employed by someone after graduation, lenders will accept 2 years of school transcripts plus your full-time new job that you've just acquired, if that makes sense. Okay. You also have to ask yourself, am I good at saving? The reason why we say that is because, like I said, first of all, when you purchase a home, when you have to fix things, you will need that extra money that will come out of your own pocket to fix anything that your home needs. In addition to that, when you purchase a home, there are many different types of loan programs, but if you choose a loan program that has, for example, a down payment, you also need to have money for a down payment and whatnot. And then pretty much just you just got to have a good money budgeting plan, in my opinion, to prepare yourself for home ownership and any type of emergencies that might pop up. Okay. When you buy a house, there are lots of different types of loan programs that you can choose from. There are 0% down payment loans that I have. There are 3% down payment loans, 5% down payment loans. There are VA loans that are 100% financed. There's all kinds of different types of loan programs that you can choose. That will depend on what your needs are, what you're prepared for, and obviously what options your lender has. Not every lender has all of the options, okay? There are a lot of lenders that only focus on one type of program, whereas myself, as a broker, I have access to every single program that is out there in the market today. So the one thing that you will want to get acquainted with once you start the loan process program, or the loan process to purchase a home, is you'll sit down with your loan officer and determine how much down payment do you want to put towards the house that you're buying. The down payment of a home mortgage goes towards your loan. So if you're buying, let's say, for example, you want to buy a $200,000 home, and you are putting, let's say $5,000 down payment, that means that your loan amount would be $195,000 instead of $200,000. Does that make sense? Okay. And vice versa. You can put obviously more down payment. The more down payment, the lower your loan amount is, and your monthly payment is based off of what your loan amount is. So the more down payment you have, the less monthly mortgage payment you will have, which obviously when buying a home is obviously is important to qualify for a loan that will give you a payment that is comfortable for you to have. I do have a lot of people that come to me and say, hey, I want to buy a house. I want to buy a house for $350,000. Okay, that sounds really good, but do you know how much the payment is going to be? No, I don't. Okay, how much do you pay in rent right now? I pay $1,000 a month. Are you used to making that payment? Is it hard for you? Sometimes it's hard. So then I tell them, look, a $350,000 loan is going to yield you quite a bit of, probably $2,000 a month or more. So that's why it's important for you to understand that the power of a down payment will help your monthly mortgage payment, and it's important for you to discuss with your lender how comfortable you are with a payment, your monthly payment, and the down payment. Any questions thus far? Yes. Yes. So after you close on your house, is that what you mean? Okay. So her question is, what if you buy a house and then you close on your house, and then you let's say you win the lottery or something, and you want to pay a bunch of money into your loan? Yes, you can do that. And then what you can also do is you can make an extra payment each month to lower your mortgage balance. However, if you have a lump sum of money, what you can do with your lender is, for example, let's say you come across $50,000 and you want to put it towards your mortgage. What you can do is you can tell your lender that you are going to put $50,000 towards your remaining mortgage balance, and then ask them to recast your loan. What a recast means is that they will take the new balance and re-amortize the payments. So if you bought a house for 30 years and you've had it for, let's say, 5 years, and after 5 years you put $50,000 down, the balance is going to go down quite a bit. So what your lender will be doing is they'll recast your loan where they will take your new balance and re-amortize your new balance to the 30-year loan, which will lower your payment. Does that make sense? The only thing that affects the interest is what interest you will pick when you start the loan, or if you refinance your loan. Okay? Typically, people purchase homes with a fixed interest rate. That means that the rate will never change unless you refinance your home to lower the interest rate or to get a cash out. You can do that. But typically, the rate will always stay the same unless you ask for a refinance to lower the interest rate. Okay? Does that answer your question? So a recast is where, so his question was, what is the difference between recasting and a refinance? Okay? A recast is when you come across a large lump sum of money and you want to put that towards the principal owing on your mortgage loan. Okay? And then, so when you put that money into your mortgage loan, you will ask your lender to recast your loan, which means when you first bought the home, you bought it for $200,000, right? Let's say that now you owe 195, okay? And then let's say that you came across $100,000 and you want to put it towards your mortgage, right? So now if you paid $100,000 in addition, then instead of owing 195, you would owe 95,000, right? But your payment, once it's recasted, it would be based off 95,000 instead of 195,000. So the payment would be lower because your balance is lower. Does that make sense? What's that? Would there be fees? No, there are no fees with recasting a mortgage. And then a refinance, for example, is, let's say you own a home, you owe $200,000, and your home is worth $300,000. Okay, that means that the difference between what you owe and what your market value is, that's $100,000. So you have $100,000 of equity in your home. That is what equity means. It's the difference between what you owe and what the market value at that specific moment is. Equity changes based on the market, right? So if you have $100,000 worth of equity and you have, let's say, $20,000 worth of high balance credit cards that you would like to, for example, consolidate or pay off, what you can do is you can do a debt consolidation refinance, borrow $20,000 from that equity to pay off your 24% credit cards in one lump sum. Okay, so that means that instead of owing $200,000, you got $20,000 out via a cash out refinance. So now you owe $220,000 because you borrowed that $20,000 to get out of debt. And so you pay off your credit cards, and then you pay the $20,000 back inside of the mortgage. And typically that payment is, typically people that consolidate debt that way do end up saving a lot of money on interest, because typically a lot of people have credit card debt that is very high, or if they have like an emergency, a medical emergency, you can get money out, you can refinance and get money out of your equity. If you want to buy another home, you can get cash out of your equity if you have the equity. You can also refinance your house just to lower the interest rate. So let's say you bought a house at 5%, and then a year or two later the rates went down to 4.375. You can call your loan officer and say, hey, I want to lower my interest rate to see if I qualify for a lower interest rate and if it will save me money. You can also refinance your house to lower your interest rate. Does that make sense? Okay. Yes. A lump sum. That's a good question. So his question is, if I recast my mortgage, instead of only recasting the payment, can I also lower the years of the mortgage? So that's a good question. In writing, so a recast will keep the terms of your loan the same. So if you bought the house at 30 years at 4%, the recast will only affect the balance. It will not affect the rate or the years. If you want to lower the years from a 30 to a 15, and in addition to that, give $50,000 and lower your interest rate, then you would have to refinance your home. Yeah, but that's a great question. Yes?
But instead of that, couldn't you just leave your whole, like your agreements the same, but then just pay?
That's a great question. So her question is, can you just leave the mortgage at, for example, 30 years, 4%? I think your question is, can I just continue to make payments and then finish the loan early? So yes, that is a great question, and yes, you can do that. So if you have $50,000 and you want to recast your loan, and in addition to that, you want to make extra payments each month, it doesn't matter if your home says a 30-year loan, because you're making an extra payment, you're going to pay that mortgage off faster than 30 years because you're making extra payments. That's called amortizing your loan faster. And I do recommend that if you have an extra $100 a month to put towards your mortgage, it will shave years off of your mortgage quite a bit. I believe that if you make one extra monthly mortgage payment a year, so one extra payment a year, I believe shaves off about 7 years off of your mortgage. That's a lot, right? Okay, any questions? Any other questions in the meantime? Great. Those are awesome questions. Thank you. Yes.
So with refinancing, isn't there a limit to how much equity you can take out?
Yeah, there are different types of refinance options for cash out. Some lenders do 80, some do 85, some do 90%. You can also do a cash out refinance on an investment property. So there are different types of loan to, it's called a loan to value, how much they will allow you to get cash out. So these are just there's so many programs for that. So if you, like I said, if you guys have any like more detailed questions, we can talk after, or you can sign up and I can have a one-on-one with you guys on just like super detailed stuff, if that makes sense. But that's a great question. Great question. Any other questions? Yes.
So for refinancing, you borrow against the equity.
Yes.
I don't think I'm understanding what happens when you then try to sell your home.
So when you okay, so let's use this example. You owe $200,000 and you borrowed $220,000. Okay, or I'm sorry, $20,000 to pay off your debt. So now you owe $220,000. 2 years later, you want to sell your home, and the home is worth, I don't know, $300,000 at that point. So when you sell it, you will pay off your, let's pretend that you still owe $220, which you won't because it will go down. So if you owe $220 and you sell it for $300, you got to pay off the $220, and then the rest goes to you. Does that make sense?
Yes, you're borrowing against what you would receive.
Yes. Yeah. And you don't really want to do that unless you really need to do that. There are a lot of people that I have, for example, my last refinance was a lady that had a huge medical emergency and she needed the cash, so she did that. Typically people that do refinance with me do it for debt consolidation for high interest credit cards. I think some of them can get up to like 25%. And then if you have like a $15,000 credit card that you're paying almost 25%, then sometimes it does make sense to do that. Obviously, let's not get into credit card debt, but sometimes you have to. There are things that happen in life, and sometimes we have to get into debt. But let's try not to do that. But if you need to do that, then there are ways to help you kind of alleviate that high monthly credit card payment in addition to your mortgage, plus all the high interest rates that you're paying on your credit cards. But we're not going to get into credit card debt. Okay, any other questions? Okay, awesome questions. Okay, so now we're going to talk a little bit about just some basic elements on what a mortgage is or what a loan. A mortgage is just another word for a loan for a house. Okay, there are different types of loan types. For example, we have a FHA loan, a conventional loan, VA loan, USDA loan, investment loans. So those are the types of loan types that you can get as a consumer. Interest rates on a mortgage, there are just a couple of different types of rates that you can choose for your loan. You have a fixed interest rate, which means that the interest rate on that mortgage will be fixed. It will never change for the life of the loan. And then there are people that choose to do adjustable rate mortgages, otherwise known as ARM loans. These are typically rates that are fixed for a period of time. So there's a 5-1 ARM. That means that it's fixed for 5 years. After 5 years, it's going to be adjustable every year depending on the market. There's also a 3-1 ARM, which is fixed for 3 years, and then after the third year, it's adjusts every year based on the market. And it's every month as well, so it adjusts every month. Why do some people choose those rates? It's because, let's say that adjustable rate mortgages are much lower than fixed interest rates, first of all. Okay. Now, let's say that you own a home and you want to get a cash out refinance to get out of debt or any type of emergency, but you also know that you are not going to live in that house for more than 5 years. You're absolutely 100% sure that you're going to move out of that house in 5 years. What some people do is they refinance their home with an adjustable rate mortgage because the adjustable rate mortgage is a lot lower than the fixed interest rate. So that means that they will be paying less interest, which means the payment will be lower. And they know that they have 5 years to either sell the home, as they were planning to initially, or refinance the home into a fixed rate if for some reason after 5 years they decided to stay in the home. Does that make sense? Okay, so ARM rates are a good tool to use if you know every tool in the entire world is a good tool to use if you know how to use it. If you don't know how to use a hammer, it's not gonna work, right? So a rate ARM is a good tool if you understand it, if you understand the risks, and just as any other tool. Okay. The term of the loan means how many years you're going to pay your mortgage for. Typically, people purchase homes at a 30-year term. So that's 365 payments. That's 30 years. Typically, most people don't stay in their first home for 30 years. Typically, it's just one home, and then they purchase maybe 2 or 3 homes during their lifetime. I've never met a person that bought a home, not as of yet. I'm sure I will at some point. I have yet to meet a person who bought their first home and still lives in it. But on a term, you can do a 30-year term, you could do a 20-year term, 25, 15, 10-year term. There are different types of terms. Now, the most important part about a term is that if the lowest payment will be given to you with a 30-year term, because the payment is stretched out for 30 years. If the payment is stretched out for 15 years, then obviously you have a large amount of money that needs to be paid in a shorter amount of time. So the payment is higher in that sense. Does that make sense? Okay. Any other questions in the meantime? Yes.
You said there are some risks to ARM rates. Can you expound on that?
Yeah, so the risk of an ARM loan, like I said, is, it's not, I think one of the biggest risks of an ARM loan is someone who doesn't know what an ARM loan is. And someone who doesn't know someone who doesn't know what an ARM loan is and has an ARM loan, it's just that their loan officer did not do their due diligence to explain it. But the only risk for an ARM loan is that it is after, so if you decide to stay with an ARM loan after, for example, the fixed period, okay, your rate can actually go up or down based on the market. So if the market is doing really well, your rate is gonna go down, okay? But the risk is if you choose to stay with an ARM loan after the fixed period, then and the market goes up, then you risk the chance of your interest rate going up. But at that point, if it does go up, then you can refinance your home into a fixed interest rate if you qualify for a fixed interest rate, or to refinance your house if you qualify for a refinance. You have to qualify for a refinance. Does that make sense? That answer your question? Okay. Any other questions about this slide here? Okay. These are really good questions. Okay, a mortgage payment is, you're not just going to pay the loan for your mortgage, okay? A mortgage payment consists of these three things. The first one is the principal and interest of your home. So if your loan is $200,000 at 4%, the principal and interest payment is based off of 4%, you owing $200,000. So let's just say that the principal and interest payment at 4% for $200,000 is $1,000. So $1,000 is the principal and the interest. And let's say that the interest is $600 and the remaining of the $1,000 is the principal, okay? The principal is what goes directly to the debt of the loan. And obviously the interest is the interest, okay? The second part that's going to go into the mortgage payment is something called taxes and insurance. So when you own a home, the county charges you taxes for your property because your home is on the land in whichever county you purchase the home. So let's say a $200,000 home, the county taxes per year are, let's say, $1,000 or $1,200 a year, okay? So we're going to take $1,200 and we're going to divide that by 12. That's $100 a month, and we're going to add that to your principal and interest payment, which was $1,000, right? So now you're at $1,100 with your taxes, okay? The other part is the insurance. Now there's two types of insurances that mortgages require. The one insurance that all mortgages require is homeowners insurance. In case your property burns down or, the home is destroyed, the lender needs to make sure that if that property burns down, let's say, I'm just being super extreme, but if it burns down, the lender needs to make sure that that property will be able to be rebuilt, and that will be done through homeowners insurance. Does that make sense? So let's say that the homeowner's insurance is like, $600 a year. It's an annual premium. Then we take that annual premium and we divide it by 12 because there are 12 months in 1 year, right? So if we divide that by 12, I think it's like $50 or something like that a month. Okay, so we're going to take the $50 for your home insurance, $100 for your taxes, plus your principal and interest payment. And now we're at what, $1,150 a month, okay? The other type of insurance is something that It's called mortgage insurance. Have you guys heard of that word, mortgage insurance? Okay. A mortgage insurance is not something that is required on all loans, but the mortgage insurance literally insures the mortgage. So it insures the person who gave you the loan. It insures them against your default, against you not making the house payments. Okay. Not all loans require mortgage insurance, like I said. If you have 20% down payment, the lender will not require you to have mortgage insurance. Okay. Now, 20% down payment, let's say of $100,000, that's $20,000. So that's quite a bit, right? So what do we do in that instance when we don't have $20,000, but we have to have mortgage insurance? Then obviously we start talking about what is the cheapest mortgage insurance that I can have on my loan, because I don't have 20% for my house. So then you have two options. You can opt to go with an FHA loan, which has the highest mortgage insurance, or if you qualify for a conventional loan, that has the lowest mortgage insurance. Okay? With an FHA loan, the mortgage insurance will never be removed from the mortgage until you pay it off or until you refinance it into a conventional loan. With a conventional loan, the mortgage insurance will disappear as soon as you have 20% equity. Okay? So that's really good to know. Now, the mortgage insurance, let's say for an FHA loan, is $100. So then we're going to add that to our $1,150, and that will be $1,250. That's your mortgage payment. Does that make sense? Okay. Any questions? Okay. Now, how do we go about buying a house? Who do I need to call? What do I need to do? Well, the first thing you need to do is you need to figure out if you qualify for a house and how much you qualify for. Okay? That's called getting pre-approved. And you do that by reaching out to someone like myself, where I will run your credit report, ask you about your employment, your income. I'll need copies of your pay stubs, your W-2s, or your school transcripts if you haven't had a 2-year employment history. And then I will take all of that information, including your credit report, and I will come up with a figure called the debt-to-income ratio. Okay? We try to stay below 50 debt-to-income ratio. The debt-to-income ratio takes only your debt on your credit report and only the monthly payments on your credit report. So if you have a car that's worth $1 million, but your monthly payment on that is $100, we are only going to look at the $100 payment, not the total amount that you owe. Okay? Does that make sense? It's important that you know that, because I've seen a lot of my clients who go out and buy like these cars that are cool and they're paying like $600-700 a month and they want to buy a house. I'm not saying it's a deal killer, but because that car payment is so high, it will affect your debt to income ratio. So try and purchase a car if you have to before you buy a house, something that is not an absurd amount of money on your monthly payment for your car. For your credit cards, same thing. Try to not have that monthly payment on that credit card be super high. Okay, it's nice and low. If you have like a personal loan, it'll show up on your credit report. But typically, not every debt shows up on your credit report, right? Your phone bill is not going to show up on your credit report. Your power bill, your internet is not going to show up on your credit report. But cars and credit cards and personal loans will. So make sure that you have those monthly payments be low monthly payments so that when you're ready to buy a house, your debt to income ratio is not very high. Yes?
How do student loans affect that?
That's a great question. So she wanted to know, how do student loans affect that? I have student debt. We all have student debt. So what's going to happen with that is if your loans are in deferment, for example, we count 1% of each loan that you owe. So just 1% of the remaining of the owing balance if your loan is deferred. If you're making payments on your loan and it shows me a monthly payment of $20, I'm going to take that $20. Great question. Any other questions in the meantime? Okay. And also, if you guys do, and I know I say credit cards a lot, it's just because I see it a lot. I see a lot of credit card debt on clients. Also, something that will really help you guys is keeping your limit on your credit card at 30% or below. That will also help your credit score, which is very important for buying a home. Okay, 30% or below. Okay. Yeah, so the pre-approval, like I said, I will determine your income, your credit. If you're going to do a down payment for the loan, I'll need to determine where that's coming from. It can come from a 401k. It can come from a gift. It cannot come from a loan. A down payment cannot come from a loan, either from a person or from a bank. It can either come from a gift, your own money, or a 401k. Okay? And it typically, yes. Yeah, so he said, how do government grants come into play when we're talking about a down payment? So a down payment, a government loan, there are some loans called down payment assistance. For one, what happens with that is they basically just gift you. Actually, I shouldn't say gift you. For example, Utah Housing, I don't know if you guys have heard of Utah Housing. They have a program where they will actually give you a loan for the down payment. So you'll have two loans, two mortgage payments, one for your house, which includes the principal and interest, taxes and insurance, plus you will pay off the loan for the down payment that they gave you. Unfortunately, with Utah Housing, you'll have two different loans and two different interest rates, which is, we want to try and stay away from that. And there are two ways to stay away from that. The first one is to be prepared and save money. I would recommend you save at least 3% down payment to buy a house. That's the minimum I would recommend. 3% of however much the house you want to buy is. So if your house is, let's just say $100,000, save a minimum of $3,000. So $3,000 per every $100,000. Okay, that's the minimum I recommend. There are other programs like I have. It's a 0% down payment where if you qualify, if you have good credit and you have income, we will gift you the down payment. Just flat out gift it to you. Okay, and that's the best program that, as far as the 0%. Now the difference here is people who do not put down payment on a mortgage have a higher interest rate, because they are not taking any risk. So the lender will offer you free money, but they'll charge you more interest, right? So I would love for you guys to just plan on saving 3% minimum so that you can get the best rate with the best type of loan. The 3% down payment is a conventional loan with low mortgage insurance. It's not an FHA loan. Okay? Yes.
What's the name of that program where if you have good credit and income that it would be gifted? Does that have a name?
Where the down payment can be gifted? I can do that with my 3% down payment. It's called Home Ready or Home Possible. Okay. Not every lender has that program. I, of course, have it because I'm cool. But that's a good question. So if you guys are planning on buying in the future, if you guys were my family, I would highly recommend, please save 3%. Forget about the 0%, zero down payment. That's not something, look, I mean, there are people that use that loan, but if you don't have to, if you have time to wait and plan, just plan for 3%. And then call me, of course. Okay, any other questions? Okay, great. Okay, and so then after I pre-approve you, so after I look at your debt, your income, all of that stuff, and you tell me how much you want to qualify for, and then we go over all the numbers, the payment, and you feel comfortable about everything we talked about, all the numbers, I'm going to give you a letter called a pre-approval letter. In this letter, it'll have my name, my company, information, and it'll say that you have been pre-approved for a conventional loan at $250,000 single-family residence, owner occupied. I will sign that letter, okay? And at that point, you will contact your real estate agent. I've invited my friend Jesus Castaneda here. He's with Century 21. So in this example, I will give him the pre-approval letter. Let's say that you choose him. And you will meet with Jesus and you will tell him, listen, I want to buy a house that has 3 bedrooms and a little yard and a nice garage. And here's my letter. I am pre-approved for $250,000. So what Jesus will do is he will ask you for what I just, all the parameters you want, and he will send you listings that are a match to what the type of property you want to purchase at no more than that purchase price. Because now we know that you either don't qualify for 250, more than 250, or you just don't want to go over that because of the payment. Okay, so he will know that information. Once you find the house that you or a house that looks interesting to you, you will let your realtor know. You will let Jesus know, and he will go and show you the home. Okay, you will walk through the home. If it's something that looks nice to you and you really want to put an offer on it, Jesus, your realtor, will take my pre-approval letter and give it to the seller's realtor and say, this person wants to put an offer on your home, so let's get going. And then that's how you get started on the process. There are some people that choose not to go with a real estate agent, and some people that do. I personally prefer to work with a real estate agent because they are very good at negotiating for you. They know the value of homes very well, so you're not going to be offering more on a house than what it's really worth. Okay, and they are just always there to help you with the entire process of negotiating with the seller and the seller's agent. As a buyer, you do not pay for their services. Okay, if you want to buy a home, you do not pay for the real estate fee. The seller will always pay for the real estate agent fee. Okay, so I highly recommend when you're ready, find a real estate agent like Jesus, and just get in touch with them after you have a pre-approval. There are some people that go out and start looking for homes, and they are not even pre-approved. And so the agent is going out showing them homes, and then they want to make an offer on a home, but guess what? You don't even qualify for a home. So don't do it backwards. Find out what you qualify for first, and then talk to an agent. Yes? Like a build? Yeah, so you can still work with an agent at that point because the builder will still, you still need representation, although you don't need it. I have a client right now who is her home, it's a condo, it's being built. She has representation from her agent, Keller Williams agent, and so her agent is handling everything for the client. The client, if the seller has a question about anything regarding the house, she just contacts her agent. The agent knows all the information, and she's pretty much serving the client as a liaison. So, but you don't have to have one. If you don't, like I said, you don't have to have one ever if you don't want one. But I do recommend one in the sense that they know the laws, they know the value of the homes, they can get easy access to the homes, and stuff like that. That's a good question. Any other questions about this slide? Oh, yeah, and also, obviously, go ahead, yes. The credit score? Okay, that's a really good question. She said, what is the average credit score to buy a house at 350? The reason that is a good question is because it is not the credit score that determines how much of a home you can buy. Okay, what determines how much of a home you can buy is the monthly payments on your credit report versus your income. The debt to income ratio is what determines how much money you can borrow to buy a home. The credit score determines whether you can get into an FHA loan or a conventional loan. Okay? The better loan is a conventional loan because it has a low mortgage insurance, and we can do a 3% down payment on a conventional loan. On an FHA loan, it's actually 3.5% down payment and a higher mortgage insurance. So that is why I want you guys to have little debt on your credit report. Don't buy super expensive fancy cars yet. Save 3%, and we want your credit score to be at about, I would prefer it to be at about 660. Even though for a conventional loan, 3%, it can go as low as 640. But the higher the credit score, the lower the interest rate. There is obviously a cap. I mean, if someone has 800 credit score, their rate is not going to be like 1%. They're still going to be, there's still going to be an interest rate. It's not going to go down that much, but the lower your credit score, the higher the interest rate. So the higher the credit score, the lower your interest rate. Yes. Yeah. That's a good question. He said he wanted to know about, the maximum credit score is like 800 something. What would be a point where you can say, okay, I've done a good job. I don't need to worry about my credit score. Honestly, it's hard to, I haven't seen very many people with 800 credit scores. I'm not lying. Probably in the past decade, I've probably seen 4. A good credit score, in my opinion, is anything above 660. But if you can get above 700, then you're really killing it. So I would shoot, if you want to just really kick it out of the ballpark, 700 plus would be good. But 660 is decent. We'll get you a decent rate. Yes. Well, as a broker, I can go down to 500, although I don't recommend that because your credit, your rate will be pretty high. And then you will be required to have 10% down payment up front. The lowest credit score I can do with an FHA at 3.5% is 580. What I do when I run into people that have those types of credit scores, I teach them what they need to do to increase their credit score instead of saying, it's all right, let's just get you into a house. Because I want to teach them how to be in control of their finances and make a better decision by understanding why their credit is that low. That's a really good question. Great. Any other questions? Are we having fun yet? Good. Okay. Yeah, so that's a little bit more on real estate agents. They're really good people to work with. They're very knowledgeable. They'll show you homes. They'll send you what you want to look for. And as a buyer, you don't have to pay for them. So use them up. It's pretty much free. So they are your buddy in the whole process, and they'll take good care of you. Okay. Once you find your real estate agent, a little bit more about that. They'll show you listings. They'll set up showings for you. They'll attend with you. They'll show you the house. They're really good people. Now, how are you going to find a house to buy? Okay. And this is where, this is why you would want to use a real estate agent, unless you want to spend all of your day looking on the internet, which most of us have jobs and we don't have time to do that. Your real estate agent spends all day doing this for you, okay? All day. If you tell him or her, say, hey, Jesus, I want this house, he's going to look all day and send you, every time a home comes in the market, he will send you that. That's what they do all day. So that's why it's very important to help your to help you find a home, okay? You'll also, obviously, when you buy a house, you'll know where you want to live. So you don't, if you work in Salt Lake, you don't want to buy a house down in, I don't know, maybe not, up in Layton or maybe higher, I don't know. What's far away from here? St. George, I don't know. So obviously you have to be prepared to say, am I willing to move to Tooele? I have a lot of people that, for example, live in Salt Lake, and home values in Tooele are a little bit lower, although they are rising right now, but they're not willing to move to Tooele. So they tell their realtor specifically, okay, don't look for homes in Tooele. Don't look for homes in Stansbury. Yes. So his question was, do you choose a real estate agent from the area that you live in? No, that is not necessarily, you don't need to do that. A real estate agent is well aware of the entire values of homes in the entire state. What you have to do is just pick a real estate agent that you mesh well with, that works hard, and is accessible to you. Yeah, you don't have to do that. That's a really good question. Really good question. Any other questions? Okay. Oh, yeah. So you can buy a house that's already built, or you can also build your own house. Okay. Building a house obviously is it's a big task, obviously, right? The building process takes between 9 to 12 months. Okay. It's a lot of work. It's not easy, obviously. You're building a house. You have to hire a contractor. You have to buy land unless you already own the land. Land is very expensive right now. So if you want to build a home, you'd have to buy the land. Plus, we would finance the costs to build the home that you want to build. So you have that option as well. Although I would not recommend that as your first home, because it's a very daunting process. Okay. Okay. You found a home that you want to buy. Like I said, how are you going to make an offer? You're going to make an offer by using my pre-approval letter, and your realtor will give that pre-approval letter to the seller's agent and say, hey, this person wants to make an offer on your home. Typically what happens at that point, the seller is looking for something called earnest money. I don't know if you guys have heard of that term. And earnest money is typically an amount of money up front that you are going to, let's say I'm selling my house. You're going to give me $2,000 to hold the house while I go through the buying process. Okay. If there's another offer on the house and someone else is offering $500, someone is offering $1,000, and someone is offering $2,000, I'm most likely going to go with the person who has more earnest money up front to hold my house while they buy my house. Does that make sense? Okay. Yes. What's that? Yeah, so he said, does the earnest money get applied to the purchase price? That was his question. So the earnest money is applied to the down payment. Okay, so if your down payment is $5,000, let's just make an easy number, and you gave $1,000 earnest money, then we can discount that from your down payment. Okay, yes. Great question. If you choose not to buy their home for any reason, you will get that money back. However, there are dates, specific dates on the real estate purchase contract that there is a specific point where you cannot back out without losing that earnest money. That's a good question. Did you have another question over here? No? Okay. Any other questions? Okay. Sweet. Okay, and then so then once the offer gets accepted, then we start the loan process, which typically takes me anywhere between 2 weeks to 3 weeks. I can take up to other people like 30 or 40 days. Okay. How do you know how much you're going to offer for the house? How do you know if you should offer 300 or 250? Okay, that is one reason why a real estate agent is your friend. They're going to know the value of that home because they have access to recently sold homes in the area, which is basically the same information that appraisers have. They have that information, so they're not going to let you offer more for a home than it's worth. Yes?
So if you're like an active real estate agent versus having a real estate license, do you have the same access, or do you just have that access if you're real estate agent working for a company?
So to have access to the MLS? To have access to the MLS, you have to be a real estate agent or a real estate broker. Is that right? Yes. So you have to pass your test, you have to be licensed, and you have to, I believe you have to have an active license, right? Yeah, and so they will give you your own personal login and password. That's a good question. Any other questions? Okay. Yes. No, lenders do not have access to that. The MLS is only for real estate agents, and they don't give us access to that, unfortunately. But if you make good friends with a realtor, they'll let you peek at it once in a while. Right? Okay. Okay, so yeah, so your realtor will help you negotiate the purchase price. Your realtor will also help you negotiate how much the seller is going to help you pay in closing costs. Okay, when you buy a house, you obviously have to pay closing costs, which include title fees for the title of your home. So like for a car has a title, right? It has your name, it has your address. A house has the same stuff, has a title. And that title is recorded at the county, saying that you are the owner of that home. Okay, title company typically charge anywhere. I mean, it varies. Well, let's say for a $250,000 loan, let's say it's $1,200 for title work. That's part of your closing costs. Some lenders charge you origination fees. They just charge you just to do the loan, which don't pick a lender that does that. I don't do that. And then, but that's also part of your closing costs. Okay, origination fees, underwriting fees. And then you have your escrow setup, which is your your interest, or I'm sorry, your taxes and insurances. You have to have an escrow setup, which is a little savings account, let's say, within the mortgage, which every time you make a monthly payment, we will take like $50 for your taxes, $100 for your insurance, and we'll put it away in a little escrow account. So at the end of the year, we'll reach in there and then we'll pay off your taxes and insurance. So when you buy a house, you have to have an escrow set up, and you have to pay that up front, which is part of the closing costs. Okay, so then your realtor will say, hey, the closing costs are $4,500 for this loan, and my buyer wants you to cover $3,500 of that. Okay, that is, a real estate agent is very well versed on negotiating and knows how much to ask for. So that's why it's important as well. Okay, they will help negotiate the purchase price and how much the seller is going to help you with on closing costs. Does that make sense? Any questions? Yes. What's that? Okay, so he said, how much should we save for closing costs? Amazing question. I love it. So besides the 3%, I would recommend that you tack about maybe just, not that you're going to use it all, maybe $4,000 more, just in case. Because remember, you'll also are going to need money to move. So it's not like you just bought a house and then you're just all of a sudden in the house. You have to, there are some expenses that you'll need, right? In addition to that, you have to pay for an appraisal when you purchase a house, and you have to pay for that appraisal up front, which means the appraisal is going to tell the lender how much, if that house really is worth $250,000 that you offered for it. Okay, and an appraiser is not going to go do the appraisal before you pay them. They have to get paid. That is typically about $500 around there, the appraisal. You have to pay for that up front. Even though it is part of your closing costs, an appraisal, you have to pay for that up front. Okay? In addition to that, 99% of people, which I do recommend, after they go under contract, they request something called an inspection of the home. This is something that you as a buyer will do out of your own accord. Okay, you will hire an inspector to go inspect the home prior to you moving forward with the appraisal. The inspection is a very detailed inspection report on the property. Does it have mold? Does it have termites? Is there a problem with the electrical? Is the roof in excellent condition? Is there, that's what an inspection report will give you, that information. You pay that out of pocket too. It's like $350, somewhere around there. Once you look at that inspection report, if that inspection report tells you that this house is a POS, you can cancel the contract and not move forward, and you go look for another house. Okay? But if that inspection report comes back and it says, yeah, this property is okay, there's just a couple things that you need to fix, you need to determine if you're willing to fix those things. Right? For example, when I bought my house, there were some electrical issues that I was prepared to fix myself because the inspection report told me the problem. I contacted an electrician who told me it was going to be $100 to fix it. So I went ahead and continued with the process. After I continued with the process, then I ordered the appraisal. And then at that point, once you order the appraisal, you're typically in it. And you pretty much buy the house at that point. But I do recommend that you always get an inspection report before you do an appraisal, because the inspection report will reveal things that are not on the appraisal. The appraisal is required by the lender, and it tells us what the true value of the home is and if it indeed is a house. That's the only thing that the appraisal really does. An inspection report tells you the health of the home, and it lets you know, if you buy this house, you're going to have to fix this, you're going to have to fix that. Are you ready to do that? Does that make sense? Unless you buy like a brand new house and you don't need an inspection report. Yes.
Now, this might not be an answerable question, but in your experience, what is about the average amount of money that is needed to fix a house?
That's a good question. Honestly, I think the average, for example, I have a client right now who is trying to buy a house that has tested positive for meth, which you can also get through, so you can do a meth test through your inspection, which I do recommend. I did that on my house as well. You could do radon testing as well. But this client is trying to buy a house that tested positive for meth. It has water damage, which most likely has mold. The bathtub does not drain. So basically this house is going to be a lot of work. So he is determining with his contractor whether it's worth for him to spend, I would think probably 10 grand or more. I've never had a client purchase a home that needed that much repair. I don't think he's going to go through with it. I wouldn't recommend that he does, because this is his first home. So he wants to live in that house. That house is not livable. If he were an investor and he had money, I would say, yeah, this is a $200,000 home. You should totally buy it. You can put, $10,000 in it and then go turn around and sell it for, $250, $260. Does that make sense? So it is important for you to get that inspection report, because once it tells you what the problems are, you can go and talk to a contractor and say, hey, how much would you charge me to fix this, and that? Based on what he or she tells you, you can determine if you really want to spend that money and continue to go through along the process of buying that house. It's a really good question. Does that make sense? To answer your question? Okay. Yeah, but there isn't really like an average amount. It just depends on how much you're willing to pay to fix the house. Okay? Okay. So after you've gone through your inspection and it looks good to you, or you're willing to take the chance to fix that stuff, then you go through the appraisal. The appraisal comes back and it tells me, yeah, it really is worth $250,000. Then we are going to lend $250,000. If the home comes back and it's appraised at $260,000, but you're under contract at $250,000, what does that mean? That means you have equity in your home, because you are buying at $250,000, but it's really worth $260,000. Okay? If it's worth more than what you're under contract, your realtor and you just keep quiet. You don't need to tell the seller that it's worth more. You just keep quiet. If it's worth less, then you say, look, first of all, if it's less, the lender, we're not going to lend you more than what the appraisal says, first of all. Okay? And then at that point is where your realtor will go back and negotiate and say, hey, she doesn't want to buy this house for $240,000 because it's worth $200,000. So you can either adjust the price down, or we're going to cancel the contract. Okay, at that point, you can cancel the contract. If they say, now, we'll find someone that will pay us $40,000 more, which doesn't really happen. In my last 10 years, I've had one person pay more for a house, and it was only like $2,000 more. It's never happened again. Typically, people do not do that. Okay? Okay? So then, once I get the appraisal back, then I will put the loan into underwriting, which means that everything will be looked at by an underwriter who will verify that all the information that I wrote down for you is correct based on documentation. If you tell me you work at Apple and you make $15 an hour, your pay stub has to say that, right? So if I tell the appraiser that the house is worth $250,000, the appraisal has to say it's worth $250,000. Okay? If I tell the the underwriter, that you are giving 3% and that you have 3% in your savings account, so I have 2 months of bank statements proving that, he or she, the underwriter, will verify that. So the underwriter's job is to verify that everything that the way that I set up the loan based on what you told me is factual with actual documentation. Okay? Once the underwriter approves the loan, Then we start to prepare closing on the home, which means that we're closer to giving you the keys, right? So we went through the home inspection, blah, blah, blah. The appraisal, we went through that. The underwriter, I just talked about that. The underwriter is going to approve the loan. And then once the underwriter says it's approved, you're cleared to close, then what I'm going to do is I'm going to call you and the title company and ask you what date you can come to the title company to sign all the documentation for your house. And at that point is when you will need to have your cash to close, your down payment and the rest of the closing costs ready to go for the title company. Okay? Right before, obviously, I mean, throughout the process of the loan, you're going to get some disclosures of figures and stuff. The beginning of the disclosure process typically has estimated numbers, but right before we close, you will get something called a closing disclosure, which will have all the actual numbers of the loan that you're going to get into, okay? And you have to review that before we can close. You have to review it, and then 3 days after you review it, then we can close the loan. If there are any issues with it, which there shouldn't be any issues on the closing disclosure, no errors, because the underwriter verified all of the figures, everything, from your county taxes to your homeowner's insurance policy to everything, to the rate. The underwriter verifies all of that. So the closing disclosure will have your factual numbers and your cash to close, and you'll sign that 3 days prior to closing your loan. Okay? With your realtor, the day before you close, typically, he will take you and walk through the house one more time before you sign on it, just to make sure that the sellers obviously didn't, put holes in the wall or it burned down, right? So you'll do a walkthrough, typically the day before you close on your loan. And then if everything looks good, then we go to the title company to have you sign all the documentation. So at the title company, you'll want to bring your ID, typically 2 forms of ID. You'll want to bring the cash to close, which I will tell you what that is. Typically, you'll wire it to the title company. And your real estate agent most likely will be there. Sometimes they're not, because they're super busy people as well. They're always driving around showing houses and doing all that stuff. And then our escrow officer, which is the title agent who will help you go through the documentation to close your loan, will also be there. And your loan officer should be there, someone like me. Okay? And so basically what you'll pay for at closing is just the cash to close, which will include your down payment plus any closing costs that the buyer, did not cover. And all of those figures will show up on your closing disclosure once we get to that point. Any questions thus far? Yes. That's a good question. She said if there are errors on the closing disclosure, can you back out? You can always back out at any point, but there is a point where you will lose your earnest money. But if you choose the right lender, there will be no mistakes on your closing disclosure. I've been blessed to never have had that happen to me in the past decade. Loan officers I'll be honest, there are some bad loan officers out there. There's probably a lot. There are some that may make a mistake, but I've never had to do that. I've actually never heard of anyone doing that. But I don't know all of the loan officers in the state. But typically, the reason why there's typically no errors is because the underwriter is actually checking all of my information to make sure that I'm also doing the loan correctly. Does that make sense? So the underwriter is like, he or she just double checks all of my work. And if I make a mistake, the mistake will be caught prior to the closing disclosure. Prior to the closing disclosure, there are some things called loan estimates. Okay, the loan estimate will be given to you at the beginning of the loan and at the middle of the loan. And typically where the loan estimates will have estimates, there'll be close estimates. But if there are major issues, we can see them in the loan estimate. At the end of the loan process, the closing disclosure will not have any errors. I've never heard of that happening, or not with me at least. Yes?
If you're looking at a house, like in the beginning
So she asked if before looking at a house, do you know what the closing cost will be? That's a great question. Remember, before we start looking at a house, we are going to look at a loan first. So your loan officer, I will go through every single detail, every single number on your loan. You will know exactly what you're getting into. Great question. Yes. That's a great question. He said, do you use cash or do you use a check? Cash is never accepted for any type of transaction on a mortgage. Okay? It will either be a wire or a money order or a, what is the cashier's check. Yeah. Okay? And for your down payment as well, make sure that you guys have that money in your bank accounts for at least 2 months. Okay? No cash. You'll never give anybody cash on a mortgage transaction. And if someone asks you for cash, then you cancel right away. Yes.
So I don't see your fees up here. So how do you get paid? I mean, you don't do this for free.
Yeah, so lenders and brokers get paid differently. A lender gets paid, so let's say, for example, well, I don't want to name any names, but let's say you work for a bank. A loan officer for a bank gets paid salary, hourly sometimes, and then they just get paid per loan. A broker like me, I don't get paid hourly or salary. I'm basically self-employed, and I have 24 different access to money that I can use. For example, like Quicken loans, things like that. I have access to those lines of credit. So when I pick a loan for a client, and I close that loan, the lender pays me, not you. And that's how you save money going through a broker, because for a lender, they charge you origination fees. Their bank charges you origination fees to use that lender through that bank. So the main point when you're looking for a lender is you want to save as much money as possible, right? So you don't want any loan origination fees. In addition to that, a lender has to have higher interest rates to pay all of their employees, to pay their health insurance, to pay their salary. So they have to increase their rates in order to pay their employees. For me, I am self-employed. So because I'm self-employed and I'm a broker, our rates are cheaper because Quicken doesn't have loan officers. They have, for example, brokers. UWM doesn't have loan officers that work in their office. They have brokers like us. So their rates are lower because they need more brokers to offer their products to their clients. Does that make sense? That's a great question. Any other questions? Okay, we're almost done. Hang in there. Okay. And then once you close your loan, you'll have to move, and I can't help you with that because I have a bad back. And then you just start paying your mortgage. So let's say we close your loan this month in February. You will skip 1 month's payment, okay? So you will make your first payment in April, right? Okay? So you'll always skip 1 month's payment. Your payment obviously will come in the mail, in an envelope, so make sure you open your mail. I've known some people that don't open their mail. Once you get your first mortgage payment in the mail, then you can call your lender and say, hey, I want to pay it directly online, or do you have a website? And then you can pay it that way. You have from the 1st until the 15th to make your mortgage payment without a late fee. From the 15th until the end of the month, you will accrue a late fee, but it will not affect your credit. If you pay it after that month, then you will get a late fee, plus it will hurt your credit. Does that make sense? Clear as mud? Just kidding. I've always wanted to say that. I've never had the chance to say it. All right. Any other questions?
How much are the late fees?
I think it's like 5% of your principal balance. That's a good question. But just try to avoid that because, I mean, you can use it if you can. I mean, if something comes up, you need to pay on the 18th. Yes.
How long should someone work in a job before they...
That's a good question. Yeah. So you need 2 years of employment history. So you can have 10 jobs in 2 years, but you just need a steady employment history. Does that make sense? And no major employment gaps. So don't take 3 months off because So if you want to buy a house, make sure that you're not taking like 3 months off because you want to go travel Nepal and then buy a house and then get a job. Right? Okay, go ahead. I don't know. I think it's about 5%. I'm not 100% sure. The late fee? No, the principal. I think it's the principal balance. I think so. Honestly, that's a good question. I'll have to get back to you on that. But it's probably like $50 or something like that, which adds up. You don't want to give money away, so try not to make your payment after the 15th. Okay? Okay, and that's, you'll skip 1 month's payment. And then basically at this point, that's pretty much it. Do you guys have any questions for me? Yes. Okay, so she's asking me about a reverse mortgage. A reverse mortgage is a product for, I believe, persons that are 65 and older that own their home, okay? And basically, if you have equity on your mortgage, they will basically pay you each month out of that equity. My opinion is that it can be a good thing, yes. If you want to leave that house to a family member after you transition, then they will just pay back whatever you took out. But that's not your problem at that point, right? So yeah, I mean, if you have equity and you need the money and you want to do a reverse mortgage, I would highly recommend that if you can. That way you don't have to sell your house and you still have money. You can still live in your house. All right. Well, if you have any other questions, yes. Oh, question?
So my question was about mortgage insurance. So you said like 3% is usually a good
It's
for a down payment. So like if I were looking at like a $250,000 house, that'd be like $7,500 that I could put down. Now, without to not have that mortgage insurance, you need like 20%, and so that's like a lot more, like $50,000. Is that, you said though sometimes that the lender can gift that the down payment or what?
so the lender will only the lender will never gift you the 20% down payment. They will gift you 3% or 3.5% FHA. Right? So it seems like your concern is the mortgage insurance, right? So if you want it, there are two options for mortgage insurance. Either you do 20%, which most of us can't do, or you try and qualify for a 3% conventional loan, which has low mortgage insurance.
And like that 3% loan, how much?
For a 250, I would think if you have good credit, so the higher your credit score, the lower the mortgage insurance as well. So I would think maybe $60. But for an FHA loan, it would be like $130 for a 250. Yeah, it's super high. So that's a great question. Cool. If you guys have any other questions, we'll be back here. You can sign up on my piece of paper, and I'll call you, and we can talk about any other details that you might have. But thank you guys so much for your time. Go Utes. It's my alma mater. Yes. Thank you.
Yeah, thank you, Maria, and thank you, Jesus, for coming. We hope you all learned something today. But yeah, feel free to sign up for a one-on-one on their sheets. And then at your seats, you all have a survey. Please be sure to fill that survey out and drop it off at the desk before you head out. That'll help us with future programming for future workshops. But thank you all so much for coming. Please grab some more food and have a good day.